In recent months, bond markets have thrown tantrums, stock markets have climbed to new highs, and the dollar's bull run has been interrupted. With me to discuss these trends and look ahead at the next few months are Choyleva of Lombard Street Research and Andreas Utermann, co-head of Allianz Global Investors. Thanks for joining us. Dana, let's go to you first. We have a chart here of the German 10-year Bund yield showing its recent jump, which was a big jump, but only took it back to levels seen in December. So the question is, what comes next? Will we see more bond market volatility? Have we seen the bottom of the bond market, the Eurozone bond market?
Well, investors might well want calm and easygoing summer months, but they're unlikely to get them. Much more increased volatility is likely. What's happening recently, or what has happened recently in the bond market, was very much about stretched positioning and poor liquidity, not about fundamentals. If we look at the euro area first, just simple supply and demand dynamics are likely to reassert themselves. At the end of the day, the net supply of bonds is likely to be outweighed by the demand from the ECB in their asset purchase program. If we then look to the US Treasury market, actually a tantrum-like spike in Treasury yields is also a risk. At Lombard Street Research, we continue to see a strong second half in terms of growth in the US, which is not the current market expectation. So that is likely to produce potentially a spike at the short end of the curve. But importantly, again, we remain positioned for flattening curve in the US because the long end continues to be driven much more by developments in the rest of the world, and we expect continued inflows into the long end.
Thank you. Andreas, do you concur with that view, or do you take a different view?
I do. I think I'd bring one other additional element into the conversation potentially, which is valuation. Now, the relevance of bond market volatility of the type that we've seen, or potential resumption of the dash towards negative yields, the relevance of that for investors is really very limited in the sense that these are not levels in which one wants to invest in the bond markets for the long term. As Diana said, this is a question of demand supply. This is most likely not the reflection of the market's view that we're headed for a decade-long deflation. And therefore, the current market valuation is just out of this world, or overvalued. So for most investors would be well advised to stay away from that market.
Do you think we'll see a slow deflation of the bond market, or a sudden outflow of funds?
I think that's difficult to predict. And as long as the ECB, particularly for the European bond market, is there, as Diana said, with a very significant bond buying program, the spikes, the upward spikes, will be contained. Beyond that, the normalization, it's anybody's guess.
Okay, so let's turn to equity markets, and we'll see the second chart here. We have the FTSE All World Developed Index showing it reaching new highs. How much further can equities go? We're seeing China's growth slowing and growth elsewhere in the developed world sluggish at best. So what is underpinning equities? Dana, let's go to you first.
Well, actually, we remain overweight developed market equities, and among those, we are significantly overweight Japan and Spain, and we remain underweight emerging markets, or actually neutral at the moment for most of them. And the only two economies that we are overweight in the emerging market space are Mexico and China. And let me talk about China, because that is a very interesting case, where you have a very sharp weakening of growth. In fact, on our numbers, we have real GDP contract in the first quarter of this year, yet the equity market has not been at all in line. Now, at face value, it might seem surprising, but actually it's that extreme weakening of growth that is causing or pushing the authorities in China to underpin the equity market, and if I borrow Draghi's phrase, do whatever it takes to support what they view is not an excessive area in the economy and will be very useful for their reform purposes.
Andreas?
I mean, what Diana referenced with respect to China, the disconnect between the underlying economy and the stock market performance is really a global phenomenon. Over the past 2 years, earnings revisions have been on a downward trend every month, and equity markets have gone up. Now, we've both, I think, on this program of the past couple of years been constructive on equities. I would again agree, we remain so, broadly speaking, because this disconnect between the fundamentals and the market performance will continue because, and that's a phrase we've coined, central banks will be having looser interest rate policies for longer than the market expects, and every time there's a bout of weakness, whether that's in China, whether that's in the US, or whether that's in Germany, there will be renewed optimism that the central banks will continue to provide ample liquidity. The one valuation measure, and this is where equities and bonds differ significantly, that actually still looks relatively attractive for equities is that of dividend yield. We've talked about that a lot as well in the past. If you look at the dividend yield of, say, the European equity market, it's around 4%, despite the very significant rises that we've seen in the market levels. 4% is not an expensive market level unless you expect dividends to fall, which we don't. They're still supported here there's more fundamental value in equities than there is in bonds.
Excellent. And quickly, as we turn to our last chart, showing the dollar and its long bull trend and then falling back down from that recently as US rate rise expectations have moved. Diana, what are your expectations for when we'll see the Federal Reserve raise rates, and are you betting for or against the dollar?
Well, given our expectation for growth in the second half of the year, our expectation for the first hike is September. But I think it's very important to make this point that the driving force here is external influences or developments pushing the dollar up that is going to determine the reaction of the Federal Reserve, rather than Federal Reserve action being the driving force drawing inflows in. We were ahead of the game in calling the dollar upswing. Despite this flattening, if you'd like, or mini correction, we continue to anticipate further appreciation of the US dollar in the second half of the year.
You a dollar bull, Andreas?
I'd say become a stale bull. I think we've probably seen the biggest part of the move. Yes, could we see another 5 or 10%? On a trade-weighted basis, perhaps, but I do think, for example, cable looks somewhat stretched from the UK perspective, so there's upside there for the dollar. If you look at euro-dollar, we may well have seen the lows in the euro-dollar in terms of the euro, and therefore it's not going to be a universal move as we've seen over the past 2 years.
And what's your prediction for the Fed rate rise?
Probably also later than the market currently anticipates, so towards the latter part of the year. But clearly, the US economy is clearly disappointing on the downside at the moment, and if it continues to do so over the summer, I wouldn't rule out an even later rise.
Thank you very much, Andreas and Diana. So it appears we can expect further volatility in bond markets and higher equity prices.